People, if you own a small business and you pay any company for anything that's not a box store, like if you're going to Walmart, Staples, or whatever, that's a given. But if you're paying any private business owner, business to business, for services or product, you're going to ask for a W-9. That W-9 is the key to telling you whether or not you issue them a 1099. He's trying to get money in the 401k, but keeping his FICA down. And believe it or not, the IRS is onto this.
Would it make sense to have my ownership interest be owned by an LLC, taxes an S Corp? In that situation, would the IRS want my reasonable salary to at least be the guaranteed payments received from the partnership, or can I have a lower salary and still meet the reasonable comp threshold? Welcome everyone to the Main Street Business Podcast with Mark Kohler and Matt Sorensen. Excited for today, the People's Show, open forum where we're answering your tax and legal questions.
Yes, this is the People Show. I like that. Nice take. If you're new to the show, someone's referred you here. Thank you for giving us a chance to wow you. We are both tax lawyers, small business owners, real estate investors. We have a law firm and a self-directed IRA company to help people self-direct their retirement accounts. We've written books. We've done this podcast for years. We have millions of downloads, and I'm just trying to wow you people. I want you to know you're in the right spot. We're a believer in small business, Main Street America. We hate Wall Street generally. Not that we both don't have products in S&P 500. You got to have some there, but we're here for you. So thanks for being here for our open Q&A.
Yeah. And if you're like, man, I want to get some questions answered, go to mainstreetbusinesspodcast.com. You can submit your questions there. And that's where our questions are coming from. Sometimes we're getting them from social media, but most of the questions we're going to be fielding are coming right off the website. So you can get over there to get your questions answered. I strongly recommend putting them down the tax legal retirement field. If you want a sports prediction or political question answered, wrong show. Wrong show.
Yeah, we are not talking about the NFL wild card playoffs. We're not. We don't. Now, there are categories at the podcast page, so you can choose the genre of your question, but sports is not one of them. So let's get to it. And now, for those that are regular listeners, you've learned to tolerate our humor and dry wit, that we are being generous calling it dry wit. Some might just call it distractions.
Bad humor.
Yeah, but we're trying to keep it real, and it's kind of fun. I got a fun story to tell during this podcast today of auto deduction. I'm really trying to. Okay. It's a good auto deduction story. So
okay, all right. I'm ready to lead off here with some Roth 401k, Roth IRA questions, small business owner trying to make contributions.
Okay. All right. Well, you throw it down. Now this is in the retirement.
This one was in the small business category, actually.
Okay. I'll jump over
Roth
there.
IRA. This is from Marky. Says, hi, Mark and Matt. I'm 40 years old, married, filing joint. I have my S corporation that provides services to clients, and I'm the only employee in the S corp. Annual net profit is $65K. I took a salary of $22,000. Okay, and $43,000 was K1. I contributed $20,500 to my solo 401k Roth account for 2022, which he says mega. I'm going to come back to this. Also matched 25% of that, $5,500, and profit shared $35,000 to max out the contribution for the year 2022. How to calculate my W-2 salary to account for my Roth 401k contributions. Okay, Marky, you're doing it wrong. Let me come back to this in a second here.
Boy, you're Mr. TLC today. Do you want to slap him while he's down? Okay.
I'm gonna slowly try to tell you how to do this correctly. But I'm glad you're asking the question, and this is perfect time because what's happening right now? Everybody's trying to do their W-2s. And this stuff's got to be reported properly on the W-2 and on your 1120S for your S Corp. So let me walk through this here. And Mark, I'll get to your Roth IRA question here secondly, because that's a good one too. All right. On the 401k, and this is for you solo 401k owners, this could apply to you even 401k at a day job sometimes. All right. You did $20,500 as a Roth contribution as an employee, right? You had an annual salary of $22,000, so you can put in the $20,500. That was the 2022 amount, and that's going right as just a Roth contribution on your W-2. And that's on the W-2. Even though you don't get a deduction for it, you still got to put the Roth contribution on the W-2. Now, the match you did of 25% of the salary, which was $5,500, that's going to go on your 1120S. That's going to go on the company's tax return as an employee retirement plan contribution. And that's a $5,500 deduction. Those are going to be traditional dollars. And moving forward in 2023 forward, these could be Roth dollars, but we're waiting for the IRS to give guidelines on how you're going to do that. But for your 2022 contributions here, that $5,500 is traditional from the employer match. It's on the company tax return, the 1120S, because you got an S Corp. Now, the rest you threw in of $35,000, you said referred to this as profit shared, the $35,000 to max out the contribution for the year 2022. And I think you're trying to do the mega backdoor Roth. That is wrong. That is not how you do it. Okay. You cannot make a profit sharing contribution for the rest of that. What you have to do is an after-tax employee contribution, which means you've got to have a salary now of at least this $6,500. I mean, this $65,000 you made, you cannot throw in $35,000 more off a $22,000 salary. Now, what you already threw in so far, fine. The employee contribution of, and the match of $5,500, I'm fine with that. But this additional $35,000, that's employee contribution, which means it has to be salary. So you've got to bump up your salary another 35 grand here, which would put you at, what is that, 57,000 in order to get there. So it's possible.
Yeah.
You got to bump up your salary, and this is an employee contribution, which is also on your W-2.
And let me add this. Thanks, Matt, for letting me interject. Is that everybody, here's what we know Marky's trying to do. He's trying to get money in the 401k, but keeping his FICA down. And believe it or not, the IRS is onto this. So there's a rule in IRS Code Section 415 that says your 401k contribution is the lesser of your 401k wages or the contribution after tax, matching, everything. So the IRS says, hey, if you bump up your FICA, you can do it, whatever, up to these incredible backdoor Roth, mega backdoor Roth strategies, but you can't cram down your salary. All of our tax lawyers have a spreadsheet where we can back into the sweet spot of where you want to be with your 401k. And because I'm an upstanding guy here and I try not to let my inside voice take over, I'm just going to leave the comment sweet spot hanging out there and not say anymore because that would be inappropriate.
Yeah. I'm also not touching it. Don't read into that comment either. All right. Let me say.
That's what okay, go ahead. All right.
Let me make a comment about.
You fell right into that one.
just like, dang,
Boy.
Okay.
All right. Now, any other comments for Marky here?
Marky, in other words, on this Roth 401k, you're trying to do this mega backdoor, max out. In other words, what Mark's saying there too is if you want to put the max 60,000, 65,000, whatever it is for the year 66 in 2023, you better have 60,000 on your W-2. They don't care about what's on your K-1. It's what's going to be on your W-2. So I know that sucks, and I know you're trying to keep your salary down, but if you want to get more in the retirement account to grow and come out tax-free, you're going to need to do this. Now, keep in mind, if you're doing the mega backdoor and you're doing this after-tax contribution to get past the $20,500 of Roth, you've also got to do a Roth conversion. You need to issue a 1099-R. You need to put that on your tax return. All right. Now, this will be on 2023. Technically, it's kind of clunky, right? Because it's a 2022 contribution, but you're actually doing a Roth conversion in 2022. And so it ends up as Roth because this is employee after tax. It's not Roth yet, but you're going to convert it to Roth. There's just no tax on it, but you do got to run through these hurdles. Okay. This is why it's a tax loophole. So if you're like, that sounds complicated, guys, I don't love that. I mean, that's the tax code. All right. We're giving you ways to max out and get a ton of money in as Roth, this mega backdoor Roth, but you do got to thread the, thread the yarn string through the holes. You know what I mean?
Yeah. Yeah.
Okay. Now I did have Marky had a good question on the Roth.
Oh my
IRA,
word! Is this the Marky show? I think he's got a little too much love here.
That's a good question.
Oh
it's
my
a good
hell!
question.
Okay.
And then you ready? This is the Marky show. Marky Mark. I contributed $6,000 to my Roth IRA for 2022. Do I report my Roth IRA contribution on my W-2? No. Okay. IRA contributions for Roth IRA, traditional IRA, those are not on your W-2. That's just going to be on your 1040 personal return. Don't stress about that. That was it. In and out fast on that one.
Okay.
Don't go there.
You know, you make doing the show really hard.
First you're complaining about me going too long, you know.
Stop talking. In and out too long.
I need a cigarette.
You know, I want to apologize to some of you out there that have kids in the car. Of course, this is going right over their head. Okay. Ethan says, my wife and I are 50-50 owners of our rental real estate LLC. We live in a non-community property state. Currently, we file a 1065 and receive K-1s. If we create a revocable living trust, which you should, in which my wife and I are grantors and beneficiaries, and we transfer ownership of the LLC to the trust, which you should, does this mean we can disregard the LLC and file our income from rentals on a Schedule E? Yes. I would prefer not to file a 1065 if possible, despite the lower audit risk. Now, for everybody out there, really one of the only reasons you would do a 1065 husband and wife is because your audit risk goes through the floor. I mean, if you're being really aggressive on write-offs, I love the 1065. But also, Ethan, you don't need a revocable living trust to do this. Unless you have a prenup or a postnup, it's going to be marital property anyway. So if you want to pop the LLC into a single member between the two of you, and file a single member LLC, feel free. Now, the trust is the creme de la creme. Just do the trust, make it the owner of the LLC, and you're clean. So that's the route I'd go there. Okay, Matt, your question. Notice how I answered that quickly, and our other listeners appreciate that. I just want to throw that out so that we can cover as much.
I just like to take my time, you know. All right, Luke.
You want to cover as much ground as possible? I get it. Yeah.
Yeah.
Woo! Boy,
right.
this is a hot and heavy show. This is good. Okay.
All right, Luke says, I have an opportunity to buy. This is in the Q&A, LLC Taxes, S Corp, and Partnership. I have an opportunity to buy into a small percentage of my employer, which is a financial services partnership. Due to becoming a partner, my current W-2 income will need to be shifted to guaranteed payment and distributions. Since my initial ownership percentage will be relatively small, a vast majority of my compensation will come in the form of guaranteed payment for services. I figure guaranteed payments will end up being $90K and distributions of maybe $5K. Would it make sense to have my ownership interest be owned by an LLC, taxes, and S Corp? In that situation, would the IRS want my reasonable salary to at least be the guaranteed payments received from the partnership, or can I have a lower salary and still meet the reasonable comp threshold? All right, great question, Luke, and you're on the right track. I would do exactly what you're saying. Get an S Corp, LLC taxes an S Corp, or just an S Corp to own your percent in this partnership LLC. Now, just because your K1 is going to have guaranteed payments on it versus net income doesn't mean you're stuck with that guaranteed payment as being your salary.
I love that comment, Matt. Good call.
Yes. So what I would do, Luke, is whatever the heck you want. Take a reasonable salary from the S Corp based on your income that you're making and your situation. Don't get hung up on what's the guaranteed payment on the K1 versus the net profit.
Okay, and I'm going to put this on the whiteboard for those that are watching on YouTube. And if you're catching this on a podcast portal and that's your preference, that's wonderful. What I'm doing here for those watching on YouTube, and all of you can get over to YouTube and just search Main Street Business Podcast and you'll see the playlist. I'm going to go to the whiteboard here and just diagram something that will visually bring this together. I'm going to bring in Ethan's comment from the last question, where we have our trifecta with the trust at the bottom, which all of you that have business owners, married, single, all of you should be using a revocable living trust. They're affordable and they can last your entire life with some minor amendments every 5 to 10 years. The trust owns the LLC on the right side. The LLC reports the rental property. Whether it's a 1065 or Schedule E, you get to choose. On the left side, I love this question by Luke. he's going to set up this LLC taxed as an S Corp, or just go straight to an Inc. Who cares? Just go Inc. And if you're a professional, you're probably going to go a PC, a professional corp. If you work with one of our lawyers, they'll walk you through which entity fits you best. We charge the same price, whether it's an Inc., a PC, or an LLC. So you're going to, but ultimately it's definitely going to be taxed as an S Corp. And that S Corp's going to own the LLC, which is at the top. So at the top of the food chain is this partnership LLC with all these partners, and then you're going to have a percentage of ownership. And like Matt said, you're going to get a guaranteed payment that should not be paid to you. It should be paid to the S Corp checking account. That's something that you're probably wondering about, the very specifics here of the kind of the mechanics. Make sure the guaranteed payment goes to the S Corp, and then any draws or profit distributions from the partnership will go to the S Corp as well. None of this money should go to you directly. Then the S Corp gives you a draw. And then after the fact, which we've talked about many times before, all of you get over to our podcast on dedicated to S Corps. We have several. You'll do a salary on paper after the fact. You don't have to actually take a paycheck, and you get to designate your salary. And frankly, Ethan and all of you out there, I don't know what your salary is going to be. We have to look at your overall income by the end of the year and your distributions. And like Matt said, just because your guaranteed payment's 90 doesn't mean your payroll needs to be 90. And if some accountant's telling you it has to be, you got the wrong accountant. This is an art form, and they're scared of their own shadow is what's going on. So tell them to tell them to be. Okay, anyway. So now we got our salary, a W-2, and a draw.
Not jumping in on these anymore.
I can't say anything on this podcast. All right. So you're going to get a K1 from the LLC to the S Corp, and then a K1 from the S Corp to you. So that's what it looks like for those that wanted to watch on YouTube.
That was a pretty picture. I like it.
Well, thank you. I'm a pretty mean Pictionary player. Just want to throw that out.
I know.
Okay. All right. Okay, James, let's pull the whiteboard. And is it my question? My turn?
Yeah, that was my question that you kind of, volleyed back. But I got another one if you're ready for me to go and you want to. I got one.
Let me throw out. Okay, go ahead. That sounds good.
All right. This is from 1099 Miss for KKOS. This is from Logan. Says, hey, Mark and Matt, I'm the dummy who recently asked about 1099s when Mark did the solo Q&A. Thanks so much for the MDS answer. It sparked a question follow-up, though. You mentioned any business you pay $600 plus during the year must get a 1099. I assume you meant service-based businesses. But does that include something like your law firm? He talks about an article he read that suggests attorneys and law firms are typically do a 1099. He says, I guess I'm struggling to see where the line is. I appreciate you guys taking the time to do these Q&As. Thanks. Okay. Yes, Logan. If you hired us to provide services for your business, we set up a new entity for you. We did some tax and business planning for you. We did your trademark, whatever. We just set up your solo K. You should 1099 as K. You're expensing that in your business. And you can call our office to get our W-9. Our EIN's also on our invoices if you need it. A lot of companies provide that, but you can get the W-9 from our office and 1099 us if you pay more than $600. Because that, assuming this was for business services, which is mostly what we're providing to our clients, that they're business owners, we're providing advice and tax legal services, which you're going to expense. In other words, send us a 1099.
Okay, and I would say this,
just
yeah,
we're okay with that.
Totally. And two thoughts. One is, people, if you own a small business and you pay any company for anything that's not a box store, like if you're going to Walmart, Staples, or whatever, that's a given. But if you're paying any private business owner, business to business, for services or product, you're going to ask for a W-9. That W-9 is the key to telling you whether or not you issue them a 1099. Because if they check the box, they're a corporation, C or S, you're out of the woods, generally. Mm-hmm. But law firms, ironically, are one of the few industries that are picked on. Maybe the IRS doesn't trust lawyers. I don't. Yeah. And the IRS says, I don't care if the lawyers check the box, they're a corporation. You're still supposed to 1099 them. We don't trust them. But anyway, so everybody out there, you need to be asking.
Accountants too, isn't it?
I don't think it's accountants. I got to double.
Oh, they just got us, the lawyers? Okay.
Yeah, it's just the lawyers. Now, they trust accountants because they want to file tax returns with the IRS. They got to stay clean. But I would say, everybody, please get over to my article on 1099s. It's at markjkohler.com. It's one of my most recent blog posts. It's one of the most popular downloaded posts of mine throughout the year. And I break it down in more detail. Deadlines, who gets a 1099, who doesn't, links to the W-9, everything you need. Make sure you're on top of it. And people, you got about a week and a half. The penalties for not issuing W-9s 1099s are ugly. And there are websites that will help you issue these 1099s quickly. Do not wait until January 30th. Get on it.
Yeah. One thing I'll say too on the 1099s is, let's say you're like traveling for business and you fly on American Airlines. All right. You're like, oh, do I need to I have a client. And then you go stay at, a Hilton hotel. And you're like, man, those are all over $600. Am I like throwing a 1099 out everywhere I go? No, those are going to be the big corporations you do not have to issue a 1099 for. Don't stress about that. Again, I think Mark said the best way. The business to business stuff is the one where you're going to want to track those and get those W-9s.
Yeah. Which brings me to the travel deduction.
Nice little segue there.
Yeah, a little segue. A couple of weeks ago, I took a travel write-off for staying in Radiator Springs. For those
Disneyland?
Yeah, I hid under a tree and they locked the doors at Disneyland, and I stayed the night. I was traveling with my significant other. We were on business, and someone forgot to fill up at the most recent gas station. That person will stay unnamed. And in the middle of the night, driving to Phoenix in the middle of the night. Let me just tell you, the drive from Vegas to Phoenix sucks. It is like two-lane road. Isn't it terrible, man?
That's a rough one.
It's terrible.
That's the worst spot. Yeah. Yeah.
They figured out LA to Vegas, easy schmeezy. Vegas to Phoenix takes a Southwest flight, trust me. But anyway, so if you start to run out of gas or take a wrong turn, again, someone should be unnamed on taking a wrong turn on the 40, you will end up looking for gas on the infamous Route 66. So at 1:30 in the morning on literally zero on the odometer, we roll into the town. I'm not kidding, that they modeled the movie Cars and Radiator Springs of. It was fascinating. Roadkill Cafe, little black and white cop car from 1930s there. It was like a little antique town. It was literally historic Route 66. I'd never been there. And all the gas stations are closed. I took out a white fence, turning a corner, and ended up staying the night in this little hotel and taking a travel deduction on Route 66.
Okay.
Valid. We're traveling for business. So I got to write that off and had to stay a few weeks and work off the fence I broke, but it turned out fine. So you can make a movie about that theoretically. Just saying that.
What's the fence? Is that like you're flipping to like Back to the Future or something? Or where was that?
You don't know the movie reference there? Doc Holliday.
Is that in Car?
Doc Holliday. But you were close.
I was right. I was close with the actor Michael J. Fox.
Yeah. Doc Holliday. Yeah. Cars was really, I thought, a play off of Doc Holliday. So Doc Hollywood. Sorry.
Hollywood. Okay.
Doc Hollywood. Michael J. Fox. Okay, so let's get over to next question. This is from BRC Felix. Longtime listener and client of KQS, married with 3 dependents, own a parent LLC, taxed as an S Corp, that owns 2 LLCs, all operational. Have a solo K, more to come. So BRC, loving your structure. We could go to the whiteboard, and everybody, that would be left side. They have an S Corp that owns 2 LLCs. Easy schmeezy. He says, here's what we're dealing with now. We are acquiring a commercial property for one of our LLCs as expansion. We will be leasing part of the building to ourselves and out to others. Might have an on-site manager that we will be hiring or contract to a third party, maybe my parents. We do not want to lose the solo K, so this LLC can't be disregarded pass-through or worse to my S Corp, right? Will it be number 2, will it be a problem with my primary solo K if this LLC investment elected to be an S Corp? Let's say there's 3 to 4. Okay, here's the big problem. BRC, your questions are assuming that your LLC owned by your S Corp is also going to own the rental building. Do not do this. This is what's called a self-rental. I love the self-rental strategy. Matt and I, one of our law offices, we own the commercial building that our law office is in. It's actually a commercial condo in a big building. So when we pay rent, we pay it to a separate LLC that owns the building. Our S Corp should not in any way, shape, or form through the parent LLC or anything own that building. So let's go to the whiteboard. Let me just whiteboard this. So what you would do is everybody.
Mark, remember, we have 2 buildings.
That's true. Boy, Matt's out there bragging. Braggadocious.
I just
Matt.
want
Okay.
to throw that out there.
Yeah, I'm just throwing that out. Okay.
We've done this twice.
We've done this twice. This is very, very common. In my certified tax network training, if you want to get certified as a tax advisor, we do a weekly training. I've got 12 modules, 60, 80 videos, somewhere in between, constantly releasing new content. Last night, we talked about the self-rental strategy and how it looks on a tax return. So that was what we worked on. So if you want to take your tax strategies for yourself or for your practice to the next level, please get over to markjkohler.com and look at my certification program. But this was our topic last night. So anyway, if we look at the trifecta, so if you visualize this, for those of you that are on a podcast, we've got our trust down at the bottom. We got a line going straight up the paper, right up the middle. On the left side, we have our operations. And let's imagine what BRC's world looks like. They've got an S Corp right in the middle on the left, and it owns 2 LLCs at the top that feed downward into the S Corp. And they've got operations up here. That's great. Do not put the rental on the left side. It is a passive entity. And so over on the right side, we will create a separate LLC just for holding the building. And this building is going to be leased to the subsidiary S Corp LLC. So the LLC owned by the S Corp will lease it from this other sister LLC. And what this does, BRC, it totally rips it out of any concern for payroll or S Corp analysis. It is a separate line of business. So under the code, it's not operational. You're going to, if you do on-site property management, that's fine. More than likely, they'd be part-time. And I would try to 1099 that out anyway. But it is not going to threaten your solo 401k, which is in the middle. And by the way, parents, Matt, aren't parents included in a solo 401k?
Yes, they could be if they work in the business.
Yeah. So heaven forbid this would get classified as an affiliated group. You would not violate ERISA by excluding your parents because your parents had the choice to play in the solo and they didn't. So I think you've got lots of options there. But so everybody, the moral of the story is if your number one best rental business is to own the building that you rent from yourself in your business. Don't pay someone else rent, pay yourself rent. That's number one. When clients go, yeah, I want to get in the rental business. I go, are you paying rent anywhere else? Yeah, I got a storage unit. Buy a storage unit. Boom. Buy a building, buy an industrial building, buy a warehouse, buy a steel building, rent from yourself. This building that I'm in right now, sitting right here, shooting my YouTube video, is a metal building that I built just for my studio because I got sick of paying rent all across town at different locations. And I centralized all my storage and all my studio work to this building. And I'm paying rent to myself. So do that, but put it over on the right side. Do not include it in your S Corp model. I think that helps you out. BRC, get with one of our tax lawyers on the setup of the LLC and you can vet the details out. Anybody that needs an appointment, you can go to Shelby at kkoslawyers.com. Shelby is our new client service manager, and she'll hook you up with one of our attorneys. Okay, let's go off the whiteboard. Thanks, guys. Okay, Matt, you choose the next question.
All right. Love this question coming up here from Benjamin. Benjamin says, just so you know, I listen to your podcast instead of music every morning at the gym.
Oh,
that much.
Ben, you're awesome. Work it. Work it. 4, 5, 6, 7, 8. Work it.
That just ruined it. We just lost him. We just lost him. All right. It says, I own an S Corp in Utah. And I love this part. I pull teeth in Utah, Texas, and Arizona. Our
Wow.
clinical entities in Arizona and Texas pay my Utah S Corp as a 1099 contractor. But is there a way to categorize my earnings in Texas and Arizona and pay the respective state taxes in each to lower my overall taxable state income? Thanks for your insight.
I cannot wait to answer this.
I mean, I pulled this one, so I can answer it.
Okay, you go
I'll give you a
first.
second shot.
I'll back cleanup. I'll do cleanup.
Ben, there is a way, but you got to leave the beehive state. You got to leave the great state of Utah. So long as you live there, they're going to tax you at their flat tax rate of 4.85%. Let's basically just call it 5%. You make $100,000. I don't care if that's on Mars, in Texas, in Arizona, in Utah. Utah is going to tax you at 5%.
Okay.
Now, you do allocate your income a little bit to Texas. You're going to allocate income to Arizona and allocate income to Utah based on, your share of where your income's coming from. But at the end of the day, it's not like you can say, well, let me just allocate all of it to Texas and I'll skip having to pay Utah. Nah. Since you're still a resident of Utah, sure, Texas is 0% state income tax. Sure, Arizona is only 2.5% now state income tax. But the difference, let's say Arizona, 2.5%, you make $100,000, you allocate to Arizona, $2,500. You get a $2,500 credit in Utah, but they still make you pay the difference, another $2,500 up to 5% in Utah. So no games unless you move out of Utah.
Yeah. Now I'm going to sticking with Matt's example, and then I'll give a different answer entirely that might be a different perspective. But Matt's example, he said you had $100,000. He's going to allocate. You're going to pay 2.5% in Arizona, and then get a credit in Utah for $5,000. Actually, it would be different. Let's say that you're a third. You're a third in Utah, third in Arizona, third in Texas. So you're going to pay 2.5% on $33,000. And then go to Utah and go, well, I only pay 5% in Utah on the $33,000 allocated to Utah. Utah goes, you're a Utah resident, so we're going to tax you on the whole 100. Now, if you allocated $33,000 to Arizona and paid 2.5% on that $33,000, we'll give you a 2.5% credit on the $33,000. And then you can, but you're still going to pay 5% on the whole hundy because you're a Utah resident. So just to clarify the math a little bit, Matt, for some of our accountants listening.
Yeah. And I think another way to think of it is if there was a 100,000, let's just say 100,000, and you paid $2,500 to Arizona.
Yes.
Utah is going to just charge you their 4.85%, but they'll give you a credit for that $2,500 you paid to another state.
Yeah. Yeah. Another way of saying it. I love it. Nice save there.
Yeah.
Just because.
Thanks. I'm just trying to.
Yeah. Matt's ego's on the line here. Okay, now I'm going to go with a different approach on the answer, the question. The question was, everybody, if I'm correct, he said, can I allocate my income in a unique way between these three states to save on Utah? The answer is no, you can't allocate it even if there's a different way of saying this, that's saying you don't even have a choice in this. You're playing games saying, well, no, Arizona's 1099ing me. Guess what? Arizona, and I'm luckily we didn't say your whole name on this show, they are going to audit you. You need to be filing in Arizona. If you are working in Arizona and you are saying, well, it's a 1099, my S Corp's in Utah, Arizona does not care. You are earning money in Arizona. So here's the big shocker. What I'm saying is not going to cost you in tax. Because just like Matt said, Utah's going to give you a credit. But right now, you're exposed in Arizona. Your S Corp should be registered in Arizona, and they should be paying your S Corp. Your S Corp should be registered in Texas. You've got liability exposure pulling teeth in those states. Your S Corp better be registered in those two states. And you're owing taxes in Arizona. Texas doesn't care. There's no state tax. But still, you have liability exposure. So you're doing business in three states.
Already doing. Yeah, I think he's already. I assume that's the case, but
well, you said he's getting
I'm just
good. Yeah,
but yeah, there's no games to play. Like it's kind of like you got to play the ball where it lies. Whatever time you're spending in Arizona or Texas is what income you allocate to those states. But for you, it's kind of a bummer because in the end of the day, you're in you're in Utah, so they're going to tax everything at the 4.85%. Sure, they'll give you a credit if you pay Arizona. Let me say the opposite, though. Let's take an opposite scenario. Let's say you lived in Texas and you're working in Texas, Arizona, and Utah. Now you might be playing some games, right? You might be like, oh, 99% of what I do is in Texas. Because if it's in Texas and you live in Texas, you pay no income tax. But in your situation where you're in a state with income tax, albeit a reasonable one at Utah at 5%, there's no strategy around it because you live there.
Yeah.
Texas or Arizona.
Wow. There are so many questions. I want to apologize to everybody in advance that we just are not going to be able to get to all of your questions today. Let me give a shot here. This is BMP Enterprises, and Cleon replied on quote unquote our behalf. And I don't mind CPAs popping in on this chat board. This is great, but let's just make sure Cleon was correct too. So BMP says, I know you mentioned that in order to be a real estate professional with a W-2 job, you need to work more in your real estate business than your W-2. That's still a leap, because it's the second part of the test is not only the hours you spend, but what's your primary occupation. It's hard to show the IRS that you work 41 hours a week doing real estate when your day job is being a chiropractor. And here we go. I'm a paid firefighter. I work 24-hour shifts with 3 days off in between. We work an average of 8 days a month with the amount of time off, 36 hours a month off. I own 12 properties. I flip properties. I'm a real estate agent with 40 transactions last year. Okay, I'm liking the argument. I'm saying it's a tough uphill battle, but look at all this great feedback. I love it. I track my real estate time with Toggle. I worked in real estate 200 hours more than my fire department job this year. Will they reject my claim for real estate professional, or is this something that is just logically because of my work schedule? Any input would be welcome. By the way, my CPA says, let's go for it, which I love. Thanks, Jason, CT firefighter. Cleon says, your tax return won't get rejected per se. This issue is that if you were ever audited, you would need to prove that you met the hours requirement. And I would add to that, Cleon, the primary occupation requirement. The records in the app would probably be sufficient. However, the more substantiated documentation, the stronger your argument. Further, it's probably wise to make the property grouping election. It's made by attaching a statement to your return similar to the following: 469-9G3 or the AF6, blah, blah, blah. Okay, Cleon, I like your comment, but here's the reality, people. When you check the box, I'm a real estate professional and I want the losses, you have to make that grouping election or it's worthless. It's not going to work. So, Cleon, my experience is, and I could be wrong, and I'm always open. I don't have a huge ego here. But everybody, when you say I'm a real estate professional, you've got a two-part test. Then you have to say I materially participate in the real estate, which is the second half. And then by checking the box, if you will, there's not a box you check per se, but you attach this election, and that's the nail in the coffin. So when Cleon says it'd be wise to make the grouping election, in our world, you're not there until you make that grouping election. That's my take, Cleon. And it's not going to hurt. Maybe we're mincing here a little bit, but the point is you got to make the election. And in our world, over the years, the election is the final piece of the equation. So, and I'll say in summary, I like your argument. The firefighters, it'd be interesting, Matt, think about all the firefighters and school teachers we have that become really prolific real estate investors. They use that time when they're not in the classroom or at the fire station wisely. And firefighters are notoriously hard workers. They're not sitting around.
My grandfather, he was a firefighter, and he had a siding business. Talk about the ultimate side hustle, a siding business. Yeah.
I didn't know that.
Yeah, he had a little siding hustle, side business. You know what I'm trying to say. So I'm trying to get some little play on words there. But a lot of small business owners. I mean, I do have quite a bit of them. So
okay.
Great question. I love the question, and I like all the detail too. Like, you're ready. Like, you know what you're doing.
Yeah. Boy, what category should we go next? You do. Why don't you jump at return? Well, you got one. Go ahead.
Yeah, I got one in retirement planning.
That's where I wanted you.
Maxed out 401k.
I love it. Okay.
I was going from Jason Brown. He says, high income W-2 owner. I'm over the IRA income limits, barely. I maxed out my employer 401k, the contribution limit. I also have several side gigs, single member LLC, so income goes much higher than the IRA will allow. I cannot do an HSA at work because the insurance is low deductible. What else can I do for retirement? Not able to do IRA due to income. Can't do more on 401k. Not interested in a solo 401k. What's the next best step?
Oh my gosh. Did you pay this guy to send this message?
I know, this is just like, he just like teed it up for me and cleared the fairway. And
oh man, you know, I don't know how you're going to
quiet, please. Signs are up.
I don't know how you're going to go from the sweet spot to where you're going next, but you go for it. Good luck.
Yeah. All right, Jason, I know what you're feeling right now. You're feeling like there's no way to get in the party for any more retirement contributions. You're feeling locked out. You didn't get an invite. You know what? Go around the back door. The backdoor Roth IRA, Jason. That's what else you can do. Okay. You're high income. You've maxed out your 401k at work. Doesn't matter. You can still do the backdoor Roth IRA for $6,000 for 2022. Goes up to $6,500 for 2023. So that's what I do first, is do the backdoor Roth IRA. We have a separate podcast episode just on the backdoor Roth IRA. I've got some videos on it. Mark's got some videos on it. At Directed IRA, we do them if you want to self-direct. We have all the details on how the backdoor Roth IRA works. So, but that's like me, Jason. I max out my 401k every year. I'm high income and can't do a front door Roth IRA or traditional IRA contribution. Okay. But every year, doing a backdoor Roth. And that's
okay. Now I'm going to give another alternative in this equation. Totally agree with Matt. But it was interesting what Jason said here. Not interested yet in a solo 401k. Why? Okay, no, they're not that expensive to set up, and the control you have is incredible. So look at the very beginning. Jason says, I max out my employer 401k, the contribution limit. I doubt they're matching up to his entire contribution limit. So let's say now, this year, contribution limit is $22,500. Let's say they're only matching Jason up to $5,000. So you put in your $5,000, you match, you double the money. Great. You've got another $17,500 to put in. Do you really enjoy the choices your employer's giving you in the 401k plan? Is that rocking your boat? Are you just like freaking loving it? Well, no, it's just easy. I just tell them to put the max in and they just withhold it from my W-2. Dude, stop the insanity. Go open a solo 401k with your side hustles. You can take money from your day job, inject it into your side hustles if needs be, and take that $17,500 and put it over in a solo 401k of which you control. You can set up a 401k LLC, invest in notes and real estate and gold and silver and crypto and 100 of things. Or put it blindly into your employer's 401k where the fees are off the chart. Now, you still do the match because that 100% match is money in the bank. But match, get out, do your Roth IRA like Matt said. But before you go back and max it out at the employer, the solo 401k could be incredible.
Yeah.
Another take.
Another reason why on the solo K, even if you are maxing out the contribution at your employer 401k and doing $20,500, you can still do a solo K. All right. You still might have, I don't know how much the company's putting in, but you can have a total of over 60 grand in a solo in 401ks in total. So you may have another 30 grand you can do. Now we'd want to look at what are the profits and net income in your single member LLC from your several side gigs. But I would consider the solo K. If you're looking at a SEP IRA, you might as well just do a solo K, because in the long haul, if you're trying to max out retirement contributions, the solo K is where it's going to be at. You might as well get the plan set up, get on the right plan that has gives you the most bang for your buck on what you can do. Now, I know you say in your example, do you want to reduce tax in this example? So you might say, but I'm not getting a tax deduction on the backdoor Roth. Well, you know what you are getting? Tax-free growth, and it comes out tax-free. That's saving tax too. But also, you can do the solo K. So do backdoor Roth, consider the solo 401k if you have enough income. Now, maybe your net income after all these side gigs is $5,000. Then the solo K is not worth it. I don't know. But if you're like, no, it's 50 grand. Okay, I love it. We're going to get a lot more money in the solo K, which could be traditional, by the way, which could give you tax deductions now.
All right.
Great question, Jason.
Yeah. Good stuff. All right. I'm going to jump over. This is an older question, but I'm kind of liking this. This is Jerome, and he said, any recommendations for a dirt cheap, high deductible health insurance plan? I can afford to max out my HSA every year, so I want to get a high deductible health insurance plan with low premiums. Cleon commented too and said, I'm interested too. Now, I'm sorry, Jerome and Cleon, that this is belated information. You've certainly probably already made a decision on your health insurance choice. But this is such a great reminder for everybody. And I wish I would have caught this question a couple months ago when you had it. But notice what's going on with Jerome. He is healthy. I mean, he wouldn't be looking for dirt cheap, high deductible insurance if he really doesn't use his insurance. So why not get a plan where if he has to come out of pocket, he's willing to, because he can always tap into his HSA if he needs to. The HSA is a tax deduction on the front page of your return at any age, at any income level. Well, whoa, not any age, sorry. Up until age 65. At any income level, you just need a high deductible plan. Now, what I would tell most people is, based on your income, start with the state exchange or the federal exchange. Some states have their own health insurance exchange portal. Others just defer to the healthcare.gov. And third, just call up a health insurance broker in your area and tell them what you're looking for. I used a health insurance broker myself, and I was excited. I just got my card. I don't have my wallet right here with me, but I got my Blue Cross Blue Shield high deductible HSA policy and for this year, and I just got the card in the mail, and I'm so excited. So now I can put money into my HSA. I've invested my HSA in a rental. I recently bought cows because I'm a Yellowstone fan. I sold those cows. I bought 5 who were pregnant, who had 5 more. So my investment doubled. We can talk about the birds and the bees for those that need that. And then I sold the 10 cows with the 5 being pregnant, with meaning 5 in the oven. So it was really a 15 cow sell. And I made money in my HSA in Kohler Dutton Livestock LLC. So, Beth would have been proud, because Beth knows the farm's got to make money. If you're not making money, you're going to lose the farm. You're going to lose the ranch. So I came through, my HSA made money. I sold the cows, because some people get too emotionally attached to their livestock. They won't sell because they love the view. They love the livestock. Not me. I was like, Beth, I'm on Camp Beth. We got to make money. So we sold.
I love it.
Did it all in my HSA. So,
I freaking love that. Okay. Is it my turn for a question? Because I got another one from Benjamin, and I'd like to give, more love to other people, but this is just a good question.
Okay. What category?
Comes up quite a bit right now. He says, this is solo 401k, the unknown. Now what? Benjamin says, Mark and Matt for president 2024, just saying I'd vote for it. Now, see, Ben knows how to get us to.
Yeah.
He knows what he's up to. This guy says,
little foreplay never hurts.
401k.
It never does.
Yeah, it's working here. He's got a good question. He says, I have a solo 401k and had one since 2017. I have approximately 300K in it. Now I want to stop for a second. He just started this thing in 2017. He's got 300K in it. That's only been 5 years, which you could totally get to that number by just maxing out your contributions and making some good investments. Not unrealistic. But a lot of people, are like, oh, I'm at 0 and I want to have hundreds of thousands of dollars. Okay, get started. Yeah. Like Benjamin did in 2017.
Great example.
Now he said, this year is the first year I own a business 100% with employees, which, as I understand, now disqualifies me from contributing to my solo K. I know I can create retirement options for my employees and myself with a safe harbor 401k. Okay, he's been listening to the show. But what about my old solo 401k? What happens to that? Do I have to roll it over into something else? Can I manage, invest it myself? Just not contribute anymore? What are the limits now? Thanks for expertise. And he also says, by the way, I did your tax attorney review and trifecta planning. Didn't get around to this question in it, but worth the money for sure to anyone on the fence. Also love that endorsement too.
Wow. Love you, Ben.
All right.
Okay.
Yeah. Okay. Now here's a great question in here. For any of you that have a solo K, once you do have a qualifying employee, which Ben has,
we're going to come. I'll come back to that one. Can I answer that part when we're ready?
Yeah.
Okay.
That's the best
well, I won't do it right now, but once you have a qualifying employee, you keep going. I'll come back and tell everybody when that trigger occurs.
Okay. Got it. Yep. Okay. So once you do have a qualifying employee, you can't do a solo K anymore because you've got to offer the same super generous 401k with 25% matching to your employees that you're doing for yourself. No one does that. And so what happens is you have a couple options. One is we just freeze the plan. You actually have to document this and you freeze the plan and say, hey, the plan isn't available to employees anymore, but you can still stay investing your funds in the solo K. Now, the IRS has not issued any guidance on how long you can have a frozen plan for. I like to tell clients a few years, don't sweat, don't worry about it. Past that, I'm not sure. I've looked for guidance multiple times on this and how long we can get away with a frozen plan. But we do know what the IRS cares about, and I've seen clients audited. We had a client who did a solo K with some other provider, and they had 14 employees in a related business that they thought didn't matter, and they got audited. And you know what the IRS made them do? Go back and contribute for all these 14 employees over years of their work and put in money into their retirement accounts. We actually put them into IRAs for them. It's a complicated mess, but so don't mess around with this. You run a big risk on having to contribute for all these employees who qualified that you didn't offer the plan to.
Okay.
So go with the freeze route, buy yourself a few years, consider what you might do in terms of the safe harbor group 401k.
All right, I'm going to provide a couple alternative, and one alternative point there too is shut down the 401k and just roll it out to an IRA. You could do that, so if some of you are like, what happens to my solo? You freeze it, keep investing it, or roll it out to an IRA and just keep rolling. Yeah.
Yep.
Now, let me give you another alternative. Now, Benjamin said, this is the first year I own a business with 100%. I own 100% with employees. I don't have enough information to answer your question, Ben, because I want to know how long have you had that employee there? Are they full-time? Are they part-time? You might get another year out of this solo. The rule is once you have a full-time employee that has an anniversary date of being with you a full year, in that year they have their anniversary date, your solo's done. But let's say you just hired your full-time employee right now and it's late January. You have until next January before they hit their 1 year anniversary. So you could still do your solo this year. And who knows if they're going to be here all year? Maybe they move on, maybe whatever. Also, there's a part-time rule now under the new Inflation Reduction Act, which I was so grateful for. I mean, inflation totally went down with that act. Biden was a genius.
Yeah, this is the omnibus bill, but yeah.
Okay, is that, sorry, I had to get in a little vent there.
Yeah.
I'm just so glad that bill was passed. I was so worried about inflation and it was just life-changing.
It's all got handled with that bill.
Perfect bill. Is part-time employees. If you have a part-time employee for at least 3 years, so they're hitting their 3rd year anniversary as a part-time, that's the equivalent to a full-time employee hitting their 1 year anniversary. But if you say, yeah, I have employees, and I'll say, are they all part-time? Yeah. Well, you got 3 years. 3 years before you have to worry about this.
2 years starting in 2024, by the way. So it's a 2-year rule because in fact, you're right, Mark. It was the original Secure Act, which made it, well, not Inflation Reduction Act, but it was first moved to a 3-year rule. But now the omnibus bill, which went into law like 4 weeks ago, changed the rule to be a 2-year rule for part-timers, but that starts in 2024.
I love it. And now here's the last thing. For you old-timer CPA accountants that love the SEP, there's only 2 reasons I do the SEP. One, I screwed up and didn't do a 401k last year, and I still want to make a major contribution on top of my regular IRA or a bigger contribution, so I do my SEP. Or you have that 1 year anniversary of your employees. So let's say Benjamin goes, well, the employees started last January and they're hitting their 1 year anniversary this year. So I've had a full-time employee for a full year. I guess I can't do the solo. That's true. You either freeze it, roll it out to an IRA. But guess what? You can do the SEP because it's a 2 year anniversary rule for the SEP. So the SEP allows you to put away a lot more than a regular IRA. I'm not a fan, but it's better than nothing. So go do the SEP. And then once you hit the 2 year anniversary with that same employee, you shut down the SEP, roll it to the same damn IRA you rolled your solo to. So keep the momentum going, Ben. There's options here. And by the way, the group Safe Harbor 401k is not as bad as it sounds. The matching is so low. It's a great way to retain employees. You get to still put away your max. You can't do a ton in matching for yourself, but it is beautiful and it's not that bad. And we are rolling out a self-directed group 401k this year. The deadline is September 31st to set it up. We will be taking care of you. So if any of you want to do a Safe Harbor, you got employees and you want to self-direct it, or you got to close down that stupid Fidelity 401k and so you can self-direct it, we got your back. So stay tuned. All right. Matt, our time is up.
That was a great time. Thanks everybody for all the awesome questions. Remember, get over to mainstreetbusinesspodcast.com where you can submit your questions. We do the open forum every 3 weeks or so. So just throw it in there. We're always pulling back between the last show and the current time when we're doing the current open forum. So get your questions in there. Appreciate all those who got the questions in today. Hope you learned something. And if not, maybe Mark made you laugh. I don't know. What? You're still listening right now. So that's
something went well. Yeah.
Maybe give us a 5-star review or something like that for it.
I love it. Well, Matt, thank you so much for your incredible, insightful comments. Thanks everybody for being here, and we'll see you next week.